Today I'm looking at a handy little spreadsheet I'm making available on my buymeacoffee.com site, buymeacoffee.com/decision analytics. Without ICS, it's ANALYTX, decision analytics. Now, this one here is Espen Haig's implied trinomial tree. It is available elsewhere. I thought I'd make it available for people in a group of other worksheets. Part of my design, part of others' design. As you can see, it was GDX. When I write strangles or try and delta hedge, this is when I delta hedge because it's a fairly cheap ETF. And it sort of goes up, and gold is not good for trend following, despite people seeing it during, and nor is it a hedge in times of trouble. I won't go into that. The gold standard no longer exists. Gold is only good for jewelry and fillings in rich people's teeth, and it has a few other industrial applications, but it's not a highly useful metal. It's certainly not a hedge against inflation or anything else. You know, can you imagine in the Weimar Republic, did they carry 3 gold bullions when, you know, a Deutschmark was worth $30,000 for a loaf of $30,000 for a loaf of bread? What are you going to carry 3 gold bullion bars down to your local milk bar? Ridiculous. Anyway, enough. I'll move on. And how it works is that's asset price, that's a strike price, the usual inputs for an interest rate. The interest rate should be 4%. We'll recalculate. It's gone up in price. As you can see, the number of steps is 4. And it's right here, the same things. This is an implied trinomial tree. It's actually its full name is the Emmanuel Derman Kani Chris implied trinomial tree. Those are 2 other individuals. I have his book where he outlines it. Mr. Chris. He worked for the Chicago's Options Exchange, I believe, and the other 2 were quants for big investment banks. It's got the thing. You can see the price differs there slightly. What's the call price there? It's 225 there, and it's 229 there. That's because there's only 4 time steps there, and there's 25 time steps there. So this is greater precision. But the reason why I included this algorithm is not because it has greater precision, for different reasons. This has the delta, the gamma, the theta, the vega, and the rho. These statistics are very useful to those who know how to use them. I'll discuss that more in another video. And this is I use this algorithm because this is handy. It shows the probabilities of the up steps, the probability of the down steps, and the local volatilities. You can see it converges to the actual volatility now, implied volatility, and they're the local volatilities at the various up and down stages, combined prices at the various steps. And that is of not much interest. That is the Euro-to-Bro price is the price which makes it risk neutral. It makes $1. At the end it's $1 because that is the exact price. These prices, they're partial. I think they should combine all close to 1, the various measures, to make them Euro-to-Bro prices. Anyway, you can look up Wikipedia further if you need to know. Now I'll move on to the spreadsheet while I've put it here. That's helpful for people who are advanced traders. It's much more useful than black skulls. But there's a few things that are difficult to get is the volatility skew. One way to get it is to get part of the spread, whether you're trading either a put or a call, or maybe both, and you take the standard deviation of the spread, and that'll give the volatility skew. And the volatility of the volatility, the standard deviation of the standard deviation will give you the skew. Generally it's a call, so I think that's a call skew. Same skew. Yeah, I'll move on to this. This is my probability of profit worksheet. It has a number of interesting features. It's my work. Now, I've included the probability of profit formula to compare to the delta formula. As you can see, the delta is 0.89 and the probability of profit is 0.8941. Most traders use delta as a proxy for being in the money, which is a proxy for probability of profit. As you can see, the delta is slightly higher. It's about nearly 0.5% higher, 0.49, 0.45, something like that. I don't do the mental arithmetic. The reason why is in probability of profit, the risk-free rate is subtracted, whereas in the delta, the interest rate is subtracted. Now, since the late 90s, we've had low interest rates, except for about 2007 and 8, I think. So interest rates haven't been a factor with 1%, 2% and 0% interest rates. They've been pretty well in accord, but they are starting to diverge, as you can see now. So yeah, if interest rates will get higher than, I think it's 4%. I haven't actually spent too much time getting the diagnostics right. In Australia, the interest rate's about 5%, I think. But this is American options. Not American, this is options traded in America, and they are American style options as well. GDX. Now what this is my warning signal, which tells me when to exit. I also have a Kelly sheet, which I've explained in another video. But this one gives a likelihood of expiring in the money. It is a fuzzy logic formula using a sigmoid function or a logistic sigmoid function. And what I do is scale from 1 to 10. The call exercise is a probability. The probability of profit is a probability. The delta is a probability. The number of days trading is scaled. And that one is whether the price, what's T3? Whether the strike price is above the call, the exercise price. It gets 6.65% added. You scale those with these various formulas, put them into the sigmoid function, and I get a rating for the likelihood of red warning. I've got it at a very high threshold, about 70%. It doesn't tell, give me some scope, because the probability of touching is far more likely than the probability of expiring in the money. So I give myself a bit of latitude, but this one was definitely going to be in the money. At the time I probably traded out. Now look at these. These are the current stock price, implied probability, implied probability. One's implied probability to put, to call. I don't change them. 31 days till expiration. These are just hypothetical. I don't want to add in real prices in real time. Strike price, winning probability, out of the money probability. as you can see, strike price. Oh, that's actually reversed. The winning probability there is a likelihood of it being out of the money. So that is actually, if you're a call buy, I'm a call rider, so I've reversed what's the winning probability. The probability of being in the money is actually 89%. The probability of a put being in the money or being out of the money is 89%, which I call that a winning probability. The probability of being out of the money, why have I got that? Well, that's not quite phrased right. The probability of being in the money is 10%. The probability of being in the money is 10%. Just delete that. Ten. That's better. And the probability of stock expiring in a range at 98% probability, it's between $25 and $36.89. And I actually use a T distribution for that because I don't trust a normal probability distribution. They're normally probability distributed, and I compare the T distribution here with the normal probability. The normal probability for being in the money is 10%. With a T distribution, it's 13%. Normal probability for being out of the money is 89%. There it's 86%. And they're compared there. Normal probability distribution, T distribution, the Z score, and there. And here's a chart showing it approximately just over 10% cut off there of the bell curve is a probability of being in the money. Being put out of the money, huh? Once again, I've got that same spelling error. Now I better save that. Because I'm going to put this on my buymeacoffee.com site for people to buy. Or if they buy me a coffee. There's just a quick little table to calculate those things. Now, that's for using with Market XLS, which is, it is running. I won't show you the prices today. I think I've showed it elsewhere. And we'll go back to the next one. This is a spreadsheet I rescued from Dr. Data, Peter what's got his name? Hasn't Peter Reckerthin, or I can't actually pronounce his name. Well, I can, but I'm not sure what it is at the moment, from Tasty Trade. He created a great worksheet, but it used to be linked to Think or Swim. Now, I could never use Think or Swim, so I immediately cracked it and made it just generally free floating, where you enter your own miscellaneous stock and price. And kept it as is. All these calculations are in hidden worksheets. You have to click on the worksheet and click on Hide to get to the workings in the table if you want to work on it. We'll see how it's done. It shows price of being 7 days out, 45 days out, the probability of being at those things. And shows the probability of being below price 7 days out. 26.5, 29.5, 60%, 40%. And there is tables of implied probability of closing above. There's all the probabilities as you go up and down. Implied probability of closing below. P&L on short, P&L on long. P&L on short, P&L on long. And the expected range with one standard deviation. 7 day, 3 day, 2 day, 1 day. Now these are all normally distributed. If you're in an extremely highly turbulent market, a chaotic market, normal distributions don't apply. So they will move far more than that in a turbulent market. They can move 10, 11% in a day. But that only happens on average every 5 to 10 years. Now it used to happen less frequently in the past. And I think that's a quick tour of the spreadsheet. If you'd like it, you can get it on my buymeacoffee.com site. And you're welcome. I hope you find it useful. Signing off.